Okay, welcome everyone. We are in the middle of a coaching session for strategic day trader members, and we have at the end of the coaching session, I like to do a lesson, and I broadcast that lesson to social media. So you get to see what we talk about all day long in the strategic day trader room. Before I get started, please make sure to read the disclaimer. Basically, understand that trading is risky and that you and only you are responsible for your trading results. Whatever we talk about and discuss in this video is for educational purposes only. Also want to encourage you to check out the links in the description of the video for further information. Today we are on lesson 8 in this lesson series that I started about 2-3 months ago. Last week we talked about trade management. It was kind of out of place. It wasn't. I'm trying to cover a series of concepts and topics so that you have a comprehensive understanding of technical analysis from A to Z. And this was kind of jumping to from A to P, right? But it was done because by request. But I hope you enjoyed it. I thought it should have been really eye-opening. Not gonna go over the entire lesson. Feel free to check out last week's video. But basically, I read, like many of you have, the book called Reminiscences of a Stock Operator by Edwin Lefevre, who wrote it about the life of Jesse Livermore, the most famous trader that ever lived. Now, in that book, I came across a passage, pages 114 through 115, where he said the following. He said, in speculation, when the market goes against you, you hope that every day will be the last day and you lose more than you should had you not listened to hope. And when the market goes your way, you become fearful that the next day will take away your profit and you get out too soon. And he goes on to say, fear keeps you from making as much money as you ought to. The successful trader has to fight these two deep-seated instincts. He has to reverse what you might call his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear that his loss may develop into a much bigger loss and hope that his profit may become a big profit. It is absolutely wrong to gamble in stocks the way the average man does. And he goes on to say, I've been in the speculative game ever since I was 14. These are incontrovertible statements. I don't care what anybody says to the contrary. But the most important part of this is what I highlighted in yellow here. Um, when the market goes against you, you start hoping that every day or every bar will be the last bar, and you lose more than you should had you not listened to hope. And when the market goes your way, you become fearful that the next bar, if you're a day trader, maybe swing trader, the next day will take away your profit and you get out too soon. Fear keeps you from making as much money as you ought to. So that's the most important part. And we went over uh, two examples when the trade went in our favor here, and then we got the red bars and how the trade made the market or the trade made money available to us here. But if you didn't take it, a lot of people end up getting out here and only to see the stock go in their way. So the point of this is to say, when the market is going your way, just be mindful that you're gonna start paying more attention to the red bars, a lot more than the green bars, because the red bars trigger your fear of giving back your profit. Now, if you're a novice trader, the moment you see a red bar, you get out. And that's why, to tell you the truth, this is a sobering fact, but not completely novice traders often do better than aspiring new professional full-time traders. Okay? Again, completely novice traders often do perform better than the slightly more advanced full-time traders. Because the more advanced full-time traders, what they do is they try and hold, but their fear is now it's just killing them, and they finally get out here, especially since it's around break even, not knowing that they had money available to them they could have taken, or if you want to hold, then learn to hold. Wait for a pivot before raising your stop. Okay? And don't let your fear control your management. So the insidious thing about fear is that it narrows our attention onto the object of fear so that we end up doing the same thing we're trying to avoid. We're doing the same thing. That's what Mark Douglas said. We do exactly what we try to avoid the most in trading, or we get what we try to avoid the most. You're trying to avoid giving back your profit, that's exactly what you end up doing. So I call this the in-between management. You have to be either tight in your management or loose. When I say tight means, get out as soon as you get a reversal against you. Loose, I'm not saying lose, I'm saying loose. Loose. Loose means give it enough wiggle room until it pivots, and then you can raise your stop. Otherwise, stick with the original stop under this, which would have been under this pivot. So either tight or loose. Figure out what suits your personality. Figure out what style is best for you based on your type of trading. Okay? And then adopt that style. The other thing that you need to consider when it comes to management is where the trade is in relationship to the target. That if it's very close to target, or when it's at target, you want to get really tight. Okay, if it's at the prior high, this is your target, you want to get really tight. If it's 50% there, or if it's, or let me back up a little bit. If it's here, let's say this is the trade, okay? When it's close to the entry, far away from the target, assuming this is the target, you have to be loose. You stick with the original stop. When it gets very close to the target and far away from the entry, you get really tight, bar by bar. When it's in between, not close to the entry, but not close to the target, try to do nothing, because whatever you do, because of those natural impulses, he calls it natural instinct, hoping and fearing. Because of that, we tend to mess up the trade if you do anything with it. So try to do nothing and just look for, what I do is I look for topping signs. I look for topping signs. Signs that the trade may not reach my target, my full target. And that would trigger my early exit rule. Okay? And we also talked about when the trader is operating on hope and the trade actually goes against them. What happens? Now they're more focused on the green bars, because Jesse Livermore said 100 years ago that when the market goes against you, start hoping that every day will be the last and you lose more than you should had you not listened to hope. So you start focusing on the green bars because they take away your fear, or I mean they give you a hope that you're going to get back to break even. And you get out when the trade is over, you look at it and say, when you get out of the trade, you feel petrified that you never even noticed the downtrend. It used to happen to me all the time. I'd look at the trade at the end of the day and say, how in the world, how could I not have seen the downtrend? How in the world did I not see that there was a downtrend going on? Why did I stay with it? Because I was really hoping to get back to break even, and I was paying an inordinate amount of attention to the green bars and while at the same time ignoring the red bars. Okay? Again, fear limits our perception onto the object of fear, making most everything else invisible. So that's the key to management, is being aware of our fear and hope, knowing that when the trade goes in our direction, in our favor, fear usually kicks in, and when it goes against us, hope kicks in, because hoping that we get back to break even. And when it goes in our favor, fear of giving back our profit. So keep that in mind. And the other thing is, know how to manage. know when to be tight, when to be loose, and it should be based on your type of trading. It should be based on where the stock is at in relationship to the entry and the target. And it should be based on your type of trading. It should be based on your personality. Some people, they just cannot give back anything. If they do, it's the end of the world for them. Well, maybe then being tight is a good idea for people like that. Because in trading, you're not supposed to confront your weaknesses. You're supposed to build on your strengths. And you can work on your weaknesses at the same time, but don't do it while you're in the middle of a trade. And so again, the three things is, there's more than just three, but one is be aware of the fear and hope impulses. Okay. Number two is figure out what your style of trade, what kind of trades you take, and whether they require loose management or tight management. And then number three is figure out where the trade is at in relationship to the target and how far away it is from the entry. There's more things to be cognizant of, such as are you really okay taking are you okay with the risk? Are you okay with the stock stopping you out, with the trade stopping out? If you're not, then you shouldn't take it, right? That's how the vicious cycle starts for most people. I offered some solutions here too for last time for dealing with this problem. Understand thoroughly how fear and hope cause a lot of problems. Accept the risk before putting on a trade. Stop perceiving market information as either painful or happy information. Maintain an objective state of mind, and know that once you know what you're doing, once you have a good handle on technical analysis, you know what you're doing, know that your losses are really the result of your psychology and not much else. Okay? I shared with you also one of my favorite quotes of all time. Uh, wasn't written by a trader. It was written by a Chinese sage called Chuang Tzu, 2,500 years ago. And he said, when an archer shoots for nothing, he has all his skill. If he shoots for a brass buckle, he's already nervous. If he shoots for a prize of gold, he goes blind. He's out of his mind. He sees two targets. His skill has not changed, but the prize divides him. He cares. He thinks more of winning than of shooting, and the need to win drains him of power. What does that tell you? In one word, what does that tell you? Maybe it doesn't have to be in one word, but what does that tell us? That attachment to your P&L, or dollar counting as it is called in trading, is the number one cause of failure. Is perhaps the number one cause of failure for most traders. Being attached to a certain P&L, to making money, right? You want to always, that's why you hear people say, trade to acquire skill, not to make money. Don't depend on trading income to pay your bills in the beginning, at least, to pay your electric and utility bills. If you do, you're setting yourself up for a failure. And it's true. It is really, really true. All right. So that was, I trust, quite a wrap up of last week's lesson. Today, I want to talk about support and resistance and how to locate support and resistance on any chart. Okay. Now, I'm going to skip a couple slides here, but that's okay. I just want to say that there are primarily only two types of support and only two types of resistance. Really. Only two types of support and two types of resistance. And it depends on whether the stock is in an uptrend or a sideways trend. In an uptrend, we have what is called minor support. Now, minor support is not necessarily, the word minor here doesn't mean like insignificant. It's just the name that was given to this type of support. But it doesn't mean it's minor, it's little, or it's insignificant. And is a price level or area that lies at or just above the prior high of a steady uptrend. The basis for this support lies in the fact that resistance this prior pivot high, right? Resistance, once broken to the upside, becomes support. Each prior high in an uptrend is considered to be an area of minor, insignificant in this case, of minor resistance or insignificant resistance. Once the stock breaks above its prior high, that peak will often serve as minor support on dips, just as a ceiling, once broken through to the upside, becomes the floor. So minor support exists only in uptrends, and it is and it is found at or near the prior pivot high. The basis for this support is that traders that shorted here will look to cover when the stock comes back down and gives them their break-even point. Their covering will propel the stock higher. Does that make sense? So, but that's not the only reason why stocks bounce off of minor support. There are many other groups of traders that look to buy at minor support. One of those groups is the shorts that shorted here, didn't cover when the stock went against them, and now get the chance to exit at break even. That's the premise behind this support. But there are many other groups. There are three other groups of traders that look to buy there. The first, the professional traders that know what's going on, that know about minor support and look to exploit it. The traders that are always looking for a pullback to buy, the ones that are the bargain hunters, right? That are looking before getting in, looking for a discount, they buy. The traders that missed the move here, that were looking to play it long as a breakout but didn't get in, now they get the chance to get in at the same price that they wanted to get in but didn't buy it. Those are called and the number four are the sold out bulls, the ones that got shaken out here. They were in it long, the stock started coming in, they got out, only to see it go back up. Now they get the chance to get back in it at or near where they actually got out of it. So those are called the sold out bulls. Minor resistance exists in a downtrend. So if a stock is in a downtrend, it has minor resistance. It lacks support. There's no such thing as minor support in a downtrend. Okay? There's no such thing as minor resistance in an uptrend. Minor resistance is what was support that was broken through to the downside becomes resistance on a rally and a sell on a retest. So when a high revisits a prior low, that's a low or a low pivot, and that's a high pivot. When a high revisits a prior low, that's called minor resistance. If we were to look at it on a chart, minor support is so let me just take out my annotation tool. Here's the stock, broke through, crashed through the prior pivot high. That prior pivot high becomes support on the next pullback. Here it is, took out this prior pivot high. That prior pivot high, at or above it, doesn't have to be exactly at it, because sometimes stocks are really strong, they don't pull back quite to the top. In this case, it just missed it maybe. So sometimes, because think about it, if you're shorted here and the stock went against you, now maybe you're down 1,000, down 2, down 3, down 5, and now you're down 3, down 2, down 500, down 200. You say, what the heck, I'm almost break even, let me get out, especially if it starts to bounce a little bit already. Meaning traders might not even wait for the stock to come all the way back down to break even. And those are the strong stocks that stay consistently above minor support. In this case, it really was at minor support. If we move the line a little bit up, that's minor support, just slightly above it. Okay, the beautiful thing about minor support is that it's a location item, and when it comes to technical, it's not just so you don't analyze the chart to locate support and resistance for no reason. You analyze it to locate and support and resistance because it's a good idea to play long at support. It's a good idea to play short at resistance. Okay? So that's why we locate support and resistance. The beautiful thing is, if you also put a 20 period moving average, minor support, minor resistance will usually be at or near that rising 20 or the declining 20. And it will also be at or near the 40 to 60% retracement percentage, which is an area where reversals have high odds of success. So from here to here is 100%, from here to here is about 40%. From here to here is 100%, from here to there is about 40%. So 40 to 60% is a great zone to look to play long. Notice the stock crashed through the prior pivot high and then based at it. In this case, it was a base sitting at minor support. Great, lovely. Minor resistance broke through support. What was support becomes resistance on a retest. So that's minor resistance. Okay? Any questions about minor support and minor resistance? To tell you the truth, I don't think it's possible to be successful without knowing this concept of minor support, minor resistance. I don't think it's even possible to be successful as a chartist, as somebody who looks to make a living trading charts, trading price action. I don't think it's possible because it's such an important concept. Now, when it comes to sideways trends, this is another example of minor resistance. Pivot low, right? Stock broke through it and back into it. That's minor resistance. That sell setup becomes high odds simply because it's at minor resistance. The only caveat in this case is this minor support, which now is, this support, which now is minor resistance, is from yesterday. So when day trading, we prefer to have the support from the same day because yesterday's traders might have moved on to another stock, so they're long gone. Okay, when day trading. Okay, so that's the only issue. Now, when it comes to sideways trends, what we have is major support, major resistance. Okay, the concept of major support and major resistance forms the foundation for numerous highly accurate trading tactics. Its main purpose is to help the T3 trader exploit the opportunities that exist in sideways trends. Because the market spends a good portion of its time trapped in neutral sideways trading patterns, it is imperative that the T3T knows how to handle adeptly, how to handle them with the following concept. We're going to cover this in detail next time, but for today, I think what I covered is enough. What I recommend as an exercise is to go review your charts and try to locate support and resistance on any chart, uptrend, downtrend, sideways trends. Sideways trends, we'll do it next time, but uptrends and downtrends. See if you can actually locate, just whatever the chart is. Doesn't matter what it is. I happen to have B's on here. Just mark it up. See if you can figure out where minor support is. Did it work? Did it not work? Minor support, minor support. Does that make sense? Mark it up. This is major support, by the way, but we'll talk about major support next time. But this is a Chinese stock, so it's a gappy stock. It's better to even do it with a non-gappy stock initially because those are harder. They gap through support and resistance all the time. And notice in a downtrend, when this stock was in a downtrend, minor resistance, right? Minor resistance. It's a gappy stock, so it's not going to be an exact price. It's an area. Okay. So I trust that was helpful, and it's a very, very important concept. We'll cover major support next time, but it's a kind of a long discussion, and we are running out of time. We are beyond the time allotted for today's session. So I hope you enjoyed the discussion. If you have any questions, please reach out to customer service. If you've never been part of the strategic day trader room, we have an incredible offer that you're invited to take advantage of. There's a link in the description where you can get 30 days for only $49 and be part of what was voted as the best trading room 2 years in a row when they ran the award Trader Planet, and the trading public voted on the best trading room. The black room, as it was called at the time, won the award for 2 years in a row. Okay, so check us out, and we hope to see you there. Thanks so much, and have a good night.